Yeah, I think liquidity management is one of probably the most under-talked about areas in evergreen portfolio management. There's so many new funds that have come to market and there hasn't been a real stress event for a long time. So I think it's crucial to look at how you think about managing through difficult periods because it's not a question of if it's going to happen, it's when. So I think the folks who are prepared will be very well suited to manage through that.
Today we're exploring a structural revolution in private markets, evergreen private equity funds. These aren't traditional raise, invest, exit, repeat vehicles, and they're causing investors to rethink how they access private markets. We'll dig into why investors may be drawn to flexibility over fixed timelines, how perpetual structures are redefining liquidity and exposure, and also cover the associated complexity and risks of a more liquid structure investing in illiquid investments. Stay tuned as we break down the opportunity, the considerations, and the mindset behind the rise of evergreen funds. Hello and welcome to the Investor Exchange. My name is William Craig, platform leader for Wellington's private equity business. Joining me today is the head of venture growth Evergreen at Wellington, Mike Trihy. Mike leads the firm's private investment activity and evergreen strategies, and there's no better person to help us navigate the structural revolution underway today. Welcome to the show, Mike. It's great to have you.
Thanks so much, Will. Happy to be here.
Before we dive into the evergreen space, why don't you tell us a bit about your investing background and what led you to join Wellington?
Yeah, happy to spend some time on my background. I have spent really the vast majority of my career investing vehicles in private markets in the wealth channel. For almost the last decade, that's been predominantly in these evergreen private markets vehicles. Started allocating to them at Partners Group, who was a very early mover in the space. Did a lot of multi-asset class allocation across both evergreen and separate account mandates there. Learned a lot about how to sustainably manage these products and manage a lot of the complexity around liquidity and stress testing and things like that. Went on from Partners to launch a new evergreen fund within an asset manager in Denver, Colorado. Helped scale that fund to nearly $1 billion while putting up pretty compelling rates of return and investing across a broad set of private markets asset classes, predominantly private equity buyout, but complemented by growth venture, private credit, liquid strategies. So a really, really broad solution there. What got me excited about Wellington was really a number of things. I think as a firm, they're suited to execute in the evergreen space. If you look at who has been successful in evergreen investing, it's typically groups that have a really strong operational infrastructure and ability to handle complexity, really good distribution, and a really strong investment program. So it's great to see the existing strength of the privates platform. And then you look more broadly at Wellington as a firm who's been operating complex investment structures for decades on the public side of the business. Really strong ability to handle the complexity here, manage liquidity effectively. We have a massive traditional asset manager in stocks and bonds that can help manage the liquid assets of the portfolio, and really a great distribution arm and great reputation, and got me really excited about the opportunity set to work on evergreen strategies in such a world-class firm.
Just a level set on the structure for our audience. What are evergreen funds? How have you seen clients incorporate them into their portfolios, and why might people want to access these structures?
Yeah, I'll take that in a few different parts. At the simplest level, evergreen funds are perpetual vehicles that take in capital typically on a monthly basis and provide some amount of limited liquidity on a periodic basis as well. There are a lot of different flavors you can see in that. Some are more institutional oriented. The majority are much more focused on the wealth channel. And if you look at these vehicles, the first generation was very heavy real estate, private credit, asset classes that were in some ways a little bit easier to manage in a more liquid vehicle. And then in the last 2 or 3 years, you've seen an explosion in private equity oriented strategies in these vehicles as well. And across all of them, it's structurally much more similar to what you see in a mutual fund or ETF construct than a traditional 10-year partnership type fund. So it's a simpler to invest structure and a little bit easier to digest, particularly for the wealth channel. So I think the reason that you're seeing increased adoption of these vehicles and increased launches of these evergreen funds is really twofold. There's kind of a more positive rationale behind it and one that's a little bit more mixed. On the positive side, I do think there's a genuine need for more of this product in the wealth channel, in retirement accounts. If you look at what's happened in the retirement landscape over the last, call it 20, 30 years, you used to have the majority of retirement assets in defined benefit plans where the risk of managing retirement assets was at the firm level, not the individual level. And the toolkit that was used at the institutional level was much, much broader than what you see in most 401k plans today. They were using obviously all the traditional asset classes, but also broad set of private markets asset classes, credit, equity oriented, hedge funds. So really had this very broad toolkit to manage retirement risk. Flash forward to today, things have completely pivoted. Defined benefit obviously still exists, but it's been shrinking for years. And now we've put the onus on retirement risk at the individual level, but given them a fraction of the number of tools that are available at the institutional side and said, good luck, more or less. And I think the more that you can open up and provide some of the benefits of private markets in that landscape and help people meet their retirement goals, I think that's a very positive rationale behind the growth of these evergreen vehicles. On the flip side, I also think there's a rationale for asset managers to want to launch and move into the wealth channel in a big way. If you look at what's happened over the last 3 or 4 years where, after the rise in interest rates in 2022, a lot of the traditional pockets on the institutional side for fundraising have really started to pull back on the private side because they're at or above their target allocation. And the result is it's been a brutal fundraising environment for several years in traditional pools of private capital, particularly on the institutional side. And I think that's driving a lot of asset managers to say, hey, we need to move into the wealth channel. This is largely untapped. Let's launch a product. And the result is just this influx of a massive amount of launches in the evergreen space. And again, I think more choice is generally good. I think many of these will be high quality products, but many probably won't be. They won't be as well thought through. Some groups may not be used to managing them in this kind of construct. So you have this kind of flood of things coming to market. So I think there's kind of a demand-driven reason that's very positive, but also the supply of funds coming online that's driven by more of a existential need to raise in the channel than maybe the immediate designing the best product for the channel necessarily. And then I think the last part of your question was how are these being used in portfolios? I've seen a few different constructs. At the simplest level, if you think about the equity side of things, you're starting to see a lot of advisors start to use this as almost a small cap alternative. One way of thinking about the risk and return is say, okay, private equity allocation is somewhat close to small cap. That's maybe a small cap replacement with less liquidity in a portfolio. The more nuanced flavor of portfolio fit that I've seen is the more sophisticated asset owners are starting to say, okay, depending on someone's liquidity tolerance, we can figure out how much they can allocate to alts. Maybe that's 5, 10, 15, 20%. And then depending on their time horizon and risk tolerance, you can figure out a different combination of evergreen funds to solve for specific client goals. So if it's someone who's on the older end, they're retired, maybe they're at the very, very low end of that liquidity spectrum, you probably allocate maybe 5% and you do a very amount to private credit, lower risk real estate, lower risk infrastructure, yielding assets. That's a good fit for a lower risk privates portfolio or in a retirement account. If you look to someone who's 20, 30, 40 years younger, has a long time horizon, you could see maybe 20% privates, maybe 70% more equity-oriented strategies and taking more risk there. And I think this kind of more model-based approach and pulling equally from different parts of the portfolio depending on the risk profile is a much more nuanced way to allocate to the space. And I think it's just starting to really expand as you've seen the initial forays into model portfolios in an evergreen context, because evergreens fit much, much cleaner in a model portfolio given the ability to rebalance than trying to do traditional drawdown funds. And I think the next phase of growth in this space will probably be a lot more model driven over the next 10, 15 years than maybe advisors going out and picking individual evergreen funds.
You raised a lot of good points. I definitely want to come back to the capital flows and demand and the potential impact on a forward-looking basis as you think about the market, competitiveness, returns. Before we get there, it would be helpful to compare and contrast the evergreen fund versus what's maybe commonly associated with private equity, which is traditional drawdown structure. So as you think about exposure, tax, administrative burdens, how do you compare the two structures?
Traditionally, drawdown funds have made up the vast majority of private equity allocations. You're typically looking at a 10-year partnership with a few years of extensions. Your money will be called down over a 2 to 4 year period very gradually, and you'll get random notices and have to fund those capital calls in 5, 6, 7 days in some cases. And on the back end, you have no control over your liquidity. Your capital is locked up, and it's sporadically 5, 6, 7 years down the line. You may start getting distributions off that portfolio, and hopefully the whole thing winds down. And I think the average life of a PE fund is like 12 plus years. It's a pretty long hold period. A lot of administrative burden coming with that as well. You have the unpredictability of the calls on the front end. You have the unpredictability of when you're going to get your money back. All of that makes it very hard to manage to a specific target allocation. Like if you want to be 5% private equity, it's very simple in an evergreen structure, which I'll get to in a moment. In a drawdown structure, you need to have a pacing plan and know when your capital calls are going to happen and distributions and be diversified across funds. The complexity level ramps very, very quickly. And you also have just a lot of natural barriers, particularly when you think about a wealth-oriented channel of very, very high minimums. I mean, top tier managers are typically 5 million minimum plus. Some will go down to 1 million. I'd say the majority are in that, call it 5 million plus type range. Obviously, that's access issue. You also have the joy of not getting your tax reporting on your K1 until usually like August, September, which is also a joy from a tax perspective. So all of that creates a lot of friction and a lot of barriers in a wealth construct. Evergreens really try to solve for a lot of those issues. Instead of a series of capital calls, you're immediately invested day one. And so the asset owner has some degree of control over liquidity. Yes, there are gates, so there's limitations on how much you can pull out of a fund. You typically see something between 2.5% to 5% per quarter in liquidity on these vehicles at the fund level. So in benign environments, they can be fairly liquid, but again, they can go very illiquid very fast in a stress scenario. But it does have a much higher degree of investor control. You also typically see lower investment minimums, anywhere from some funds run $1,000, but I'd say the majority are in like 25K, 50K type minimums. Much more accessible for the majority of the wealth channel versus the millions you're looking at on a typical fund. And again, tax structures vary, but many will be much more simple from a tax standpoint. Either a really streamlined K1 that comes out at the beginning of the year, or a 1099 tax reporting, which is a lot simpler. The goal of these vehicles is to take away a lot of those frictions that you've seen on the drawdown side in terms of getting exposure to private markets.
You do have liquid assets combined with a semi-ish liquid structure. So how do you think about managing liquidity? And particularly in a space like venture and growth, where the investments perhaps are a little longer in duration than something in buyout and certainly in credit.
Yeah, I think liquidity management is one of probably the most under-talked about areas in evergreen portfolio management. There's so many new funds that have come to market, and there hasn't been a real stress event for a long time. So I think it's crucial to look at how you think about managing through difficult periods, because it's not a question of if it's going to happen, it's when. So I think the folks who are prepared will be very well suited to manage through that. And I've always thought about managing liquidity in an evergreen context through a few different layers. Starts with just proper investor education on the front end, letting people understand this is a long-term product. These are ways to get immediate exposure to private markets. They are not liquid. They can be liquid for periods of time, and they are certainly more liquid than a typical 10-year partnership. That does not make them a liquid vehicle. Then you move into the asset allocation itself. I always like to have a spectrum of liquidity, starting with a liquid bucket and then moving into more mature investments that's like secondaries that are 4, 5, 6, 7, 8, 9 years old that are throwing off distributions quickly. And then your true illiquid investments that are newer and just starting to generate returns. You take all those assets, you stress test them bottom up and assume, okay, if 2008 hits, can you still hit your minimum gates for at least a 2-year period? And I think if you can solve that stress test, it puts you in a really good position to manage through pretty much any challenging liquidity environment. And then the layers behind that are things like credit lines. For many folks, their first line of defense, I've always thought of them as the last line. They really do nothing but buy you time, but that time can be important. It lets more distributions come off the portfolio. But obviously you have to make sure that those credit lines are termed out appropriately and are going to be there for you when stress hits. I think in that context, they can be really additive. And I also like to think about how you even structure your client base. If you avoid having too much concentration at the client level and having exposure to a broad set of different client types, it can set you up to be more resilient, because different types of clients are going to behave differently in a stress environment. If you have some institutional, some large distributors, some RIAs, some family offices, that creates a more stable base in a stress environment than if you have everyone in one investor type who's all going to move as a herd. That can be a challenging thing to manage through from a liquidity perspective. But I think that combination of asset allocation, kind of backup lines of defense, and proper education can set up a fund like this to be successful from a liquidity perspective, even when things get really choppy.
When you bring together the exposure, the structure, the liquidity management, what's the type of return profile on average an investor might expect from an evergreen structure?
Yeah, it's funny. So the evergreens, optically, if you look at the returns, I think many who are traditional private market allocators will say they seem very low. Many who are traditional public market allocators will say, wow, those are quite attractive. And it comes down to a lot of the structural aspects we're talking about here. A lot of that comes down to the difference of comparing IRR and time-weighted returns like you're looking at in these evergreen vehicles. IRRs assume you're getting a similar rate of return before that capital is called and after it is distributed. In reality, a lot of folks probably are not managing that liquidity perfectly. And where it's most interesting to compare is take the IRR out of the equation, because it's so easy to kind of game and can be shifted so easily. A multiple on a typical top quartile private equity fund, depending on the vintage, is going to be something like a 2x net multiple over 6 to 10 year type time frame. An evergreen fund that's doing 12% per annum net is going to be 2x net return in just over 6 years. So again, that would put them firmly in top quartile private equity land because of the effect of being immediately invested in compounding, as opposed to a private equity fund that takes years to call the capital. So I do think the returns are pretty compelling in these evergreen vehicles, particularly given that compounding of capital and that ability to stay invested. I don't think they're a good replacement for like the largest institutions. If you have a really robust program of hundreds of primary fund commits that you're managing on a vintage year weighted basis, by all means keep doing that. In the wealth channel, where a lot of folks who have no private markets allocation, or even the smaller end of institutional, where fund to funds has been a real challenge in terms of it takes forever to get invested, double layer of fees. We're increasingly seeing these vehicles turn up in institutional channels as an alternative to a fund to funds allocation. So I do think there's some interesting solutions where this makes more sense. But again, the larger ends of institutional, I think, is already pretty well covered with their existing approach on a primary fund basis.
Let's move on to the market environment and two topics that are grabbing headlines, certainly artificial intelligence, as well as secondaries, increasing demand for secondaries given some of the liquidity issues over the past few years. What are your take on these trends in the context of an evergreen structure?
Oh man, there's a lot to unpack there. I'll tackle AI first because I probably have a little bit less to say on that topic. I think obviously increasingly important segment of the economy. And as you think about it as an allocator from an evergreen context, there's clearly very attractive aspects to AI from an investment thesis. I mean, it's transformational technology, and you're starting to see it in terms of the enterprise uptake. There's been mixed results in terms of seeing how much the actual efficiency improvements are there, but they are generating tons of revenue. So it seems like a lot of the things are in place for this to be a really compelling investment thesis. On the flip side, you also have an incredible amount of money flowing into the space. You have really, really lofty valuations where if there's even a slight misstep in terms of how fast this technology develops and if things are slower to come around, I think there could be a lot of pain in the space as well. So it's a really challenging thing to think about as an allocator. I think if you just say I'm going to avoid it entirely, you risk potentially having any exposure to what could be the most transformational technology of the last 50 years. On the flip side, I think you need to be very risk conscious about how you do that. I think it's important to include as part of a portfolio. You cannot size it in such a way where it's going to make or break your performance. I think it's important to participate and be there because I do think in 5 or 10 years, even if there is a near-term correction, there will be some big winners in AI. And I think you want to have that exposure. Moving on to secondaries, a totally different topic. Probably one of the most controversial areas within the evergreen fund world in recent months and years. There's a few different levers that are making this such an interesting area. So in traditional secondary funds, and I'll quickly define, in a secondary context, we're talking about providing liquidity to participants in private markets. Most of that is in the form of LP secondaries. So someone's in a private equity fund, they've been in it for 5 or 6 years, they need liquidity for one reason or another. It could be a big pension fund who's having a liquidity squeeze. They'll go out to the secondary market and sell it. Someone will buy it at typically a discount, maybe 70, 80, 90 cents on the dollar, and they'll just take over their LP interest and take all the distributions coming off that fund for the rest of its life. There's also an increasing growth of GP-led secondaries and other more complex secondaries. For purposes of our discussion, I'll lean on the LP side because I think that's most relevant for what we're seeing in a lot of the evergreen fund world. Now, in drawdown funds, when you go out and buy a secondary interest, if you're a secondary manager, the accounting treatment has always been you go out, you buy something at 80 cents, and you immediately mark it to the GP NAV, which is 100. So you get this immediate pop in value. And then over time, you may get continued upside performance. It may decay a little bit. At the end of the day, as an investor, though, everyone's coming in at the same cost basis in that fund, and the return is going to be whatever the distributions coming off that book are in 5, 10, 15 years. So it's not all that controversial in a traditional drawdown fund structure. In an evergreen fund, it gets a lot more interesting because all of a sudden you get that same accounting treatment. You're buying into it, you're stepping up that value immediately. So you take something from 80 cents, you mark it to 100, you're at a 1.25 day one. Everyone who's now subscribing to that fund is buying in at that new stepped up NAV. And what that means in practice is, because you're always diluting those positions down, if you grow very, very quickly and raise a lot of money in a vehicle that is predominantly LP secondaries, you can put up really eye-popping rates of return. That's a really interesting dynamic in that it doesn't seem all that sustainable because if the pace of fundraising slows, all of a sudden that legacy portfolio is going to be growing much, much slower. Now, if they've done their underwriting right, it's not going to be negative returns. It should be, continuing to generate positive returns, but the returns are going to come way, way down over time. But you can really juice them by this use of buying things at a discount and ramping them up. Now that's the first layer of this. The next level of it is when you have a lot of these vehicles in the market at the same time, it starts having an impact on the secondary market itself. If you think about having dozens of vehicles who are going out and buying LP secondaries at scale, and all of them are taking in money every quarter, and their option is sit in cash or buy secondaries, they're intrinsically going to be willing to pay more for a secondary than anyone else because their alternative is to sit in cash and have cash drag at the fund. And the result is you're starting to see, I think, a lot of very aggressive pricing in the secondary market, particularly on the buyout side is where we've probably seen this most acutely, and a little bit in credit, where there's some incentives to deploy in a way that's different than a typical drawdown fund. And it's having impacts on the secondary market itself, which is obviously a little bit concerning as well. Taking all of that together, I worry a little bit about these growth of just dedicated secondary buyers in an evergreen context. Now that all sounded very negative. I actually love secondaries as part of an evergreen vehicle. I think they can be a phenomenal tool. I think they are better utilized as one tool across a broader toolkit in an evergreen fund. So you allocate some percentage to secondaries, you use it as a tool day one when you launch to get some diversification, and then quickly build out a more direct-oriented portfolio where you can't raise money as fast. You have to be a lot more disciplined around your fundraising, but your returns are going to be driven by the growth of the underlying businesses as opposed to just this pull to par at acquisition. And then you also have secondaries there as a tool if you ever need to flex in during a serious stress environment, because secondaries when markets get really choppy can be one of the best areas to allocate. People panic, they start selling. You've seen discounts widen out to 40, 50%. Really great to have that flexibility to move in there. So it's a great tool to have in an evergreen fund, but I hate to have it be your only strategy because, again, I don't think you get rewarded for having a really limited opportunity set in a vehicle like this. And the last thing I'll mention is that there are pockets of secondary where this really increased competition hasn't bleed through yet. You've seen it a lot in credit and buyout where pricing has gotten really tight. If you look more broadly, areas like infrastructure and growth venture in particular are really undercompeted. You have not seen pricing tighten up the way you have more broadly. So I think there's pockets you can play in even now in this crazy competitive secondary environment that are still pretty attractive. But broadly speaking, it's really starting to make the broader secondary world challenging to operate in, particularly for closed-end funds who don't have an evergreen fund to compete at this tighter pricing.
Let's stay with pricing. I have a variety of discussions with institutional investors who are thinking about the evolution and structure, what the potential additional demand means for forward-looking returns in private equity. How do you compete in such a competitive environment when pricing becomes so in focus in terms of all of the dollars looking to be invested in the space?
That's a really interesting question. I mean, you're seeing it in secondary land right now for sure. I think it's going to impact not just returns for evergreens, but returns for broader secondary managers. Because again, it's hard if you're a buyout manager to compete. So you've either got to find really proprietary off-market deals. You have to operate in smaller, more niche pockets. But if you're just like a mega fund going out and buying traditional LP deals, it's tough. And I think that's what's driving a lot of the growth of the GP-led secondary market because, again, returns are starting to look more attractive there because I think the LP side has been a lot harder to get the returns you're looking for. But taking this out a bit broader, what does it mean for the broader private equity ecosystem to have this much money flowing into a space? It'll be interesting to see. I don't know that it's going to have as massive of an impact as you would think. And I think that'll come down to where these evergreen funds eventually evolve. I think there's going to be a lot of mega fund managers who are going to have massive evergreen funds, but they're already deploying such large drawdowns, and those drawdowns are getting harder and harder to raise because the institutional money is coming away. So I don't know that it's suddenly going to mean that they're going to do $60 billion buyouts instead of 20. I think they can still probably operate in that 20 billion type range. Maybe they do a deal or two extra a year. But again, they've already kind of started looking more like almost PE beta to a degree at that scale. I don't think it's going to have a huge impact on that pocket of the market. And as you look at the other end of the spectrum, I think there's a lot of opportunity for smaller, more niche strategies in the evergreen world that are more alpha focused. And I think there's so much opportunity outside of the large cap private equity that gets most of the attention that the money flowing in there shouldn't have a huge impact near term. Now, if you look out long enough, 20, 30, 40 years down the line, if these grow enough and the institutional world doesn't shrink as much as maybe people expect, there could be this net massive increase in private markets AUM. But again, we've already seen that over the last 10 or 15 years. Private markets AUM has doubled or tripled. And I mean, returns have certainly not been quite as strong as they were in the early days, but they're still well above public markets on average. So I don't think you've seen that thesis come to fruition yet. But I do think at a long enough time, if enough capital moves into a space, it's going to be detrimental to returns, full stop anyway. I don't see that happening near term in the next 5 or 10 years, but you look out long enough, it's definitely a risk that I think I could see why institutions would be concerned about it.
So I have one last question for you, Mike. And I think from what we've seen in terms of flows and fundraising is that adoption, potentially mass adoption, is underway. What would you leave our listeners with in terms of the biggest learning curve as they evaluate this type of a structure?
So there are a few different aspects, I think, in terms of like learning curve and things to focus on. The one as an industry I think that we need to work on the most is just really basic asset class level education. I think a lot of advisors are getting more familiar with private markets, but I think it's still relatively early days on that education. I think you have a lot of advisors who are still somewhat skeptical about private markets in general. I think they see, hey, these are high fees, there's tons of products coming to market, and like for good reason they have a degree of skepticism there. But I think if they go a step deeper and start to really learn about how these asset classes function, the return potential, how they can help stabilize portfolios. There's even an element of mental comfort that some clients get from like, even though the volatility is just as high, if not higher, in terms of like true risk to privates, you don't see that volatility every day, which actually I think in some ways can have behavioral benefits to end investors, where it can help investors stay invested if they don't see these big market swings from day to day. Even though the risk is still very much there, you just don't see it on a day-to-day basis. A lot of this falls on asset managers to just continue to focus on education and helping advisors understand. The other element is going to be the complexity that comes from so many different funds being launched. I think it's very hard for the advisory world to do like manager level diligence in this space, like for them to go on site with a manager and get comfortable with single manager funds here and single sector. It's getting more narrow. It's never going to be as narrow as drawdown world, but it's getting more complex to underwrite. When there was only a handful of funds in the space, you just said, okay, I'll pick one of these 3 or 4 and I can just do this. It's getting much more complex now. And I do think that's where there's a big opportunity for models to move into this space in the next 5 to 10 years. I think that's going to help a lot with the education side, where you say, okay, we'll have private markets experts who work on the actual model allocations and solve for different risk tolerances. That'll help a lot in terms of like advisors knowing how to have the right mix in a portfolio.
Thanks, Mike. We certainly covered a lot of ground today, and I learned a ton. And we really highlighted the structural revolution underway in private markets as Evergreen strategies see continued growth and adoption. Thank you all for joining us on Investor Exchange. That's Mike Trihy, Head of Venture Growth Evergreen Investing at Wellington. Mike, thanks again for being here.
Thanks so much, Will. Great to be here.
The Investor Exchange podcast is a production of Wellington Management. Our producers are Amanda Doherty, Colin Hopkins, Mark Murphy, and Dana Wickstead. The show is recorded, mixed, and edited by Mark Murphy. Production support from Dave Crow and Rasa Sirma. Animation support from Rasa Sirma. You can listen to the Investor Exchange at wellington.com or wherever you get your podcasts. Thanks for listening.
All investing involves risk, including potential loss of principal. Past results are not a reliable indicator of future results. Forward-looking statements should not be considered as guarantees or predictions of future events. This material was current as of the publication date. Wellington assumes no duty to update the content in the event that the information changes. This commentary is provided for informational purposes only. It is not research that is required to be prepared in accordance with legal requirements designed to promote the independence of investment research, and it is not subject to any prohibition on dealing ahead of the dissemination of investment research. It should not be viewed as a current or past recommendation and is not intended to constitute investment advice or an offer to sell or the solicitation of an offer to purchase any securities. It does not take into account the investment objectives, financial situation, or needs of any actual or particular person. Wellington Management does not provide legal, tax, or accounting advice. The views expressed are those of the speaker and may not reflect the views of others at Wellington. This recording may not be reproduced or distributed in whole or in part for any purpose without the express written consent of Wellington Management. Please refer to the disclosure section of this podcast for complete details.